Jimmy, how are you?
I'm doing great, Jeremy. How are you?
Good. I recognize that sometimes we don't really introduce one another in these things. So let's just real quick back up a little bit and do that. We're from On Track Wealth Management. We're both certified financial planners. We're here in Canton, Michigan, and that is where the headquarters is.
That's right.
You're also a CPA,
That's right.
so you love
I
taxes.
love taxes.
And we're doing what we always do every quarter, which
Yep.
is talk about the market insights where we take a little bit of a look behind us and a little bit of a look forward and try to give insights to people who are out there thinking about their portfolio design, thinking about their financial plans. What do they need to think about? How do they need to react to the market? That's really the gist of it.
Well said.
All right, let's get after it. So the portfolio points that we've got here, kind of big ones, balance and rebalance. There's always opportunity when you've got a market like this, isn't there?
Absolutely. Rebalancing, I think it makes a lot of I think a lot of folks understand rebalancing, getting back to your long-term targets, but I think the value in rebalancing is oftentimes underappreciated.
There's no doubt about that. Tax loss harvesting, that's something that some people do, some people don't. We try to take advantage of it a lot, not through just ordinary means. We like to do direct indexing and custom indexing where you can actually automate some of that. We're going to
Right.
give kind of a year's review of where we're at right now
Right.
on that tax loss harvesting.
I think the big thing there is a lot of times people do tax loss harvesting in the fourth quarter only, where
Right.
the strategies that we're talking about are being run year round.
And then finally, we gotta throw it in there, the election.
Oh, there's an election coming up?
Right, right. It's 2024, and yeah, we're almost there. We're
Yeah.
almost through. We're 2 weeks away from this thing being over,
Thank
and we're
goodness.
going to talk about what it means if one guy or the other gal wins. We've been doing this all year, where we kind of look at 2024 according to a fun thing that Dr. David Kelly from JP Morgan kind of laid out uh, with 2024, kind of using that as the starting point.
Mm-hmm.
You want to see 2% GDP, 0% recession. This is predictions, I should say. 2% inflation, 4% unemployment. And honestly, it's been pretty spot on.
Right.
Here we are, GDP. It's been trending actually up.
Yeah.
You can't argue with it. GDP's up.
That's a good thing.
Yeah. Recession chances, really, there's no chance of a recession here in 2024.
Not in 2024.
No,
Nope.
sir. Inflation,
Yeah, it's slowing. I mean it's cooling slowly, but it still is moving in the right direction.
and unemployment, maybe it's heated up just ever so slightly. It's lukewarm.
Yeah. Well, these are the things that are obviously the Federal Reserve is tasked with a very difficult job. And how do we bring inflation down without impacting unemployment, because those are their two mandates, right? They need to price stability with inflation and full employment. So it's a really difficult task for them to, when you think about where we were in 22 from an inflation perspective and the amount of rate hikes that we've lived through, and now we have our first rate cut that has happened. So it's certainly a very important macro point to be considering in your portfolio.
Well said. So the IMF, the International Monetary Fund, they published this World Economic Outlook. There's a lot of bean counters on this thing.
Yep.
It's very interesting. It's another data point that's out there that's respected, and they're going to give a global view, but they're also going to give a country by country view.
Mm-hmm.
And what we're seeing here is that sort of a lackluster global growth at 3.4%. Remember, if a developed nation were running at 3.4%, that would be very good,
Right.
But
Yeah.
there's a lot of emerging and countries out there that you would expect to be 5, 6, 7% growth.
Right.
So aggregate 3.4% is nothing that's going to knock anybody's socks off.
Right.
It's actually estimated to come down a little bit in 2025. But there's some bright spots within the mix, aren't there?
Right. And we're one of them.
We are. So it's absolutely, the U.S. continues to be a beacon for financial stability and growth.
Yep, absolutely. I find it, Brazil and Britain. I mean, stark contrast in some of the other countries that, saw growth rising in 2024, right? So to your point, one of these developing nations, Brazil certainly falls in that category, right? One that it's not difficult to see how they could have, mid to high single digit growth. It's not difficult to see how they would have that. But it is interesting to see, taking a look at everybody as a whole. Again, we've talked a lot about investing internationally, in the past, and this is certainly a good look in the macro picture of the global equity and fixed income markets.
No doubt. And then one of the things they pointed out was that there's some trade risks on the horizon potentially. And both, if you look at, it's not just in the United States exclusively, but let's take an example. Both candidates for president are talking about tariffs. One's talking about them more than the other, but they did an analysis that was irrespective of a particular candidate winning. But they just said if tariffs were going to be raised by a certain percent, here's what you might expect. You might expect an impact of nearly 1% in 2025 on the global growth and over 1% in 2026. So look, at the end of the day, tariffs and isolationism, fighting from a globalization and free trade market is not good for the economy.
No question.
So they're calling that out as a risk. We believe it's a risk.
Yeah.
Back to the U.S. U.S. consumer, what are you seeing here?
I mean, the consumer looks like they're doing pretty well, right? You look at the household net worth changes, and we're at an all-time high. So this is certainly a positive note because the consumer makes up 70% of GDP. So it's not surprising that when you look in the U.S. and we see this chart that, that kind of checks out that when we see, the U.S. and our GDP growing at the rate that it is, well, it's supported by the fact that the consumer is, never been better or never been wealthier from a overall balance sheet perspective. So, I think it's important that we try to enjoy that when things are good. And I think it's so easy to have a pessimistic outlook on a lot of things. But look, right now the data tells us that the consumer is doing well, and the GDP proves that out. So this is a very positive chart to look at.
And this checks out with what we see when we're talking to people on an individual basis too. And not to say that everybody's doing great and nobody's hurting. That's not at all what we're suggesting. But generally speaking, people are doing well, and it's right there. If you own a house, right, you're probably doing much better than somebody who doesn't.
Right.
And if you have investments in the capital markets.
Yep.
In the publicly traded markets, you're probably doing well as well.
Absolutely.
So, hey, there's two little bits of information that people should really heed as potential financial, opportunities.
No, yeah, absolutely.
The other thing here, there's sort of a deleveraging of liabilities. So the liabilities compared to net worth, we're at a really, really low point here. The least leveraged in 37 years, in fact.
Well, this would check out from the last chart, right? When you have the consumer's net worth has never been higher, there's two sides to the net worth statement. There's the asset side and there's the liability side. So we see assets growing and we see liabilities falling, would check out to the consumer in a very strong position. But debt, funding any purchase with debt anytime you add leverage to the equation, it brings on this risk, right?
Yeah.
Of are you able to make the payment back? Well, it's nice to see when the percentage of the net worth is now trending in a very good direction.
Exactly. And so the picture within this, goods have historically come down in terms of their overall prices. That's helpful. Certainly when you look at the opportunity that presented itself for homeowners over the last few years with historically low interest rates.
Yeah.
And you could get 30-year mortgages for under 3%.
Right.
It's like hitting the lottery.
Yeah.
So there's a lot of good news in here. But yet, the funny thing is, consumer confidence is still below the average in a pretty significant manner. So what you're seeing on this chart here is off to the right in the green. It's showing September 2024. The number for consumer sentiment is about 70.
Mm-hmm.
The average is about 84.5. So we're significantly lower in terms of how we're feeling.
Right. Well, this is, I like to use my golf analogy here. My golf swing instructor used to tell me feel and real aren't the same. So you feel like you're doing something, but then when you get to see it on camera, what you're really doing doesn't match up with what you feel.
Okay.
And so this to me, I take away the stock market climbs a wall of worry. It's been a mantra that's been around for a long time. But here you go. We've got really good market performance year to date and from the capital markets, and yet the consumer still is well below their long-term average sentiment. So feel and real aren't always the same.
Yeah, and what they're telling you here too is that when you have these low points, these troughs in consumer sentiment, look, it's sort of contrarian, right?
It is.
It's just you're probably going to have a good stock market for the foreseeable future.
For sure.
So again, let's ride that train while we can.
Agreed.
Inflation has been the story. It's becoming less so of the story, which is nice. If we can report less on inflation and more about other data points in the economy, we'll all be happy.
No question.
I think we're almost getting there. We're down to 2.5%. The trend and the goal is 2%.
We're getting there. It's happening slowly, but it does seem very clear that we are trending in the right direction to getting closer and closer towards the Federal Reserve's long-term target of 2%.
Yep. So you called it out. Obviously, the big news in September was a 50 basis point rate reduction.
Right.
Okay.
That was surprising. I mean, I know there were plenty of pundits that were calling for the 50 basis points. I was a little surprised that they went with the aggressive move of going 50. I'm not saying that they shouldn't have. I mean, again, they have far more data in front of them than we have to assess. But it was surprising to me that they made that jump into 50 basis points. It'll be interesting to see, and this is what we're looking at here. What is their projection moving forward? Are we going to keep going at 50 basis points? Are we going to go 25 basis points for a few quarters? But we had said long ago, we're not worried about when they start cutting. It was going to be how much are they going to cut and how fast are they going to do those cuts. That's the important part to take into account. So look, we still have a ways to go, right? If we're going to get to 2% long-term inflation, the goal is to typically have it 1%. Your federal funds rate to be 1% above that inflation rate.
Right.
So we still got to get down to 3%. So there's still a little ways to go.
Certainly. And here's the thing that I would add. There's some really smart folks, especially in the bond portfolio management space, who are starting to say now, look, expect this thing to take a little bit longer to get it down to that terminal rate, that end mark where they're comfortable. They're going to go slow.
Yeah.
Maybe slower than what we expect. And so what you see in this chart here is that in the green, you have the market expectations. They see you getting there pretty fast, and they actually see you going lower than what even the Fed projects. Now, we've talked about this ad nauseum. These predictions are almost always wrong.
Right.
So they're just a direction, probably in the right direction. It's
a data point in a moment in time.
But, what I would take away from this is that some smart people who really look at this thing are saying, hey, look, cool your jets a little bit. This thing's going to take longer than what we thought.
Agreed. Yep.
All right. So now the cool story outside of that is you're in a rate cutting environment. What does it do to the stock market?
Right. Well, I mean, historically, or I would say in theory, most rate cutting cycles would be, it would start when you're trying to stimulate the economy, right? When you might have been in a recession.
Correct.
Right. So things appear to be slowing, and then you would cut interest rates to stimulate economic growth. And now the question here, though, is, as we mentioned before, it seems like there's a 0% chance for a recession here in 2024.
Yep.
Right. So yet we've already started a rate cutting cycle. So interesting to see what happens, or I think this goes back to 1984, is it? So you're talking about 40 years of data when we've had 3 cycles where there was no recession, but we did have rate cutting activity going on, it's obviously been a very good thing for the stock market.
Yeah, undeniably. So it's a good environment. It gives you some, I guess, green shoots for the future here, the near term future. It looks good, looks positive. We'll take it for what it's worth.
Right.
One of the perhaps arguments, though, within the markets right now is that things are overvalued,
Mm-hmm.
and that it's increasingly hard to buy in at a number that people would feel or should feel perhaps comfortable with. Now,
Right.
that's a highly debatable subject, and there's a lot of different opinions out there. There's a lot of different metrics out there. What you're seeing here is the forward PE ratios all the way back to 94 through 2024. Where we're at right now is 21 and a half forward PE. Okay. What is the average? Well, the average is, 16 and 3/4.
Right.
So we're above that pretty significantly.
Right.
But we talk about this a lot. What does it really mean? I mean, I'm curious what it means. You can talk about, does it mean don't buy into the large cap market that's overpriced? Does it mean go down the cap structure? Does it mean sit in cash? What are the
Yeah.
thoughts?
Well, again, this is assessing the price to earnings ratio of the S&P 500. So I think, again, to your point, these numbers get a little skewed because of the FANG stocks, the Mag 7, whatever you want to call them. They've been such large contributors to the growth of the S&P 500 in the past year or so. So their valuations are maybe stretched a little bit more, relatively speaking. I think if you were to look under the hood, the rest of the underlying positions not as expensive as a whole. And if you think back to the previous chart we looked at, a lot of those sectors that were not information technology did very well in the rate cutting non-recession cycle. So maybe that speaks to a broadening of the stock market performance, that so it's not so concentrated in the top holdings. But when you look at this, it's telling you the price that you're paying for each earnings per share of the S&P 500 constituents is more expensive than it has been for the last 25 years on average. That doesn't mean it's going to stop. It certainly means it can certainly go higher. It's not the highest point. It can certainly go higher. But I think this definitely could play into the consumer sentiment piece that we saw earlier.
Yep.
There's some concern and some worry about the market because maybe things are just too expensive, and people might feel like they've missed out on some investment opportunities for some of those few companies that have done exceedingly well in 2024.
And for me, it goes back to what we talked about earlier, the rebalance opportunity. It may be a really great opportunity for you to rebalance.
Yeah.
Take some profits, rebalance them into, depending on where you are in your retirement plan, maybe you go a little bit more into the fixed income. Maybe you don't go more into the fixed income. Maybe you put some more into the Russell 1000 for a broader diversification in the large cap. Maybe you go to some value,
Right.
mid cap, small cap.
Sure.
Strategically, there certainly are opportunities overseas in
Right.
the developed and emerging markets. So it's a rebalancing opportunity is probably my biggest kind of theme.
I think that's very well said.
All right, so talking about and being allocated to different stock and bond ratios. Here we're looking at everything from 100% equities all the way down to 100% fixed income and all the variance in between. This is how we've performed year to date.
Yeah, so no surprise that the stock market has done well. So if you were in the purple box there with the all equity, you're the top performer. And however, I would say it's still nice to see that you've had positive performance in the fixed income market, but certainly not to the degree of the equities. So obviously the risk on trade has been rewarded this year. And I would point out that there have been a few dips here in the market, as you can see. So this is the year-to-date calendar year through 2024. You've seen a couple dips, but those are just not very large dips, right? And the average declines that we've seen in the market just haven't really played out in 2024. So again, let's just enjoy the good times when they are good. When you've got a upward moving, nicely trending, and not a lot of volatility. Let's enjoy the good times when they're good.
And I know we talked about this earlier in the year, but when you start out in Q1 and you have such a good Q1, and then you have a good Q2, halfway through the year, you're so far up that you can actually afford, from a market perspective, to take a pretty sizable dip and still be on top.
Right.
And that's exactly where we are. Look, we really never drop below zero in any of the typical asset allocations where you're, at least 50% in stocks.
Right.
And it's just a story of early successes have buoyed this market throughout. And even though we've now seen a few dips here in the latter part of the year, we've been able to just ride them out, and we've recovered as well. So we're in good shape.
Yeah.
So that balance and rebalance concept, the asset allocation, asset class returns is what I meant to say. You can see in the white here, between the bands on the screen. Look, you don't go all in on one thing on purpose,
right?
Because it's very hard to predict who's going to be a winner and who's going to be a loser. But when you balance that out, you can be a winner.
So I've always loved, I refer to this as the periodic table of returns, right? And I love this because, you see the benefits of diversification, and you can see some quantification of the volatility that's associated with the different investment strategies and the asset class returns. But just seeing, where we're at year to date with the diversified portfolio, it's been a great year for that diversified, that 60-40 portfolio. And I think there was some discussion of, is a 60-40 portfolio dead? Well, it's been far from it in 2024. And it's nice to see the returns with the reduced volatility. Again, you want to make sure that the whole idea of rebalancing is making sure you don't get too risky without really realizing how much risk you have in the portfolio. You have a very few concentrated positions. So seeing the diversification and the importance of risk management, rebalancing, to the point you made before, certainly seems like an opportune time at this point.
Yeah, and I think this story of rebalancing is one that is very individual.
Absolutely.
Some people, they don't need to rebalance as much as others. There's no one formula here.
No.
So that's what we believe. We're not rebalancing on the mark every beginning of the month.
Right.
We're really assessing and looking at the market and one's portfolio and looking at where they are in their financial plan journey,
right,
to figure out what makes sense for them. But it's the point being is that you need to be thinking about it.
Absolutely.
All right, we're going to shift tax loss harvesting.
Love it.
This is a slide that we just love. This tells you so many different stories, doesn't it?
Absolutely.
So walk us through it real quick. Give us the kind of the contemporary view of this too.
Yeah. So what we're looking at here, these again focusing on the S&P 500 calendar year returns. So the dark gray bars recognize the annual return for each calendar year, going all the way back to 1980 here. So the red dots are showing you the intra-year decline that was recognized during that year.
So the low water mark, if
exactly,
you will, right? Okay.
From whatever the peak to that trough. And yet what you'll see is, so there's a lot of the red numbers, I think, is what people always want to avoid, but they want to experience all the gray bars above zero.
Naturally.
So what you come to find, though, is that the average year we have over a 14% decline during every single calendar year. Yet if you were to avoid or not pay attention to volatility, and you just held your investment in the S&P 500, 33 of 44 years have produced positive returns. So, and this is only looking at the price return. This is not accounting for reinvested dividends, which would make those numbers even better. But you are rewarded more times than not for managing or maintaining an allocation to the S&P 500, regardless of the declines that might happen throughout the year. So what we see as it relates to this year, we've only had an 8% intra-year decline. So, far less than the average of over 14%. So not a lot of volatility, yet we've had really nice returns for the year.
Yeah. And I would say that, if I was looking at this year 6-8 months ago, I would have said we were going to see a lot of volatility.
I would have thought so.
And
election
we
year.
have not. So go figure.
Right.
It's been below average for an election year.
Yep.
We've still got a full quarter, well, not a full quarter, but 2 months left at least.
Right.
And look, we it is what it is. It's been a very positive year, which leads us to our next points. Um, just another viewpoint here. You're looking at now a different slide. This is the Russell 1000, so the 1,000 biggest large cap U.S. companies. And look, since 2000, the dark blue line is the Russell 1000, and that's in 2024.
Right.
Fantastic year. Again, everything that you've been hearing from us and we've been talking about, just hasn't been a lot of opportunities out there to do tax loss harvesting because the conditions haven't been right.
Correct. And this is something that, again, that direct indexing I mentioned, in the beginning of the discussion here, that is taking advantage of volatility year round. Again, a lot of individuals and a lot of advisors out there focus tax loss harvesting only in the fourth quarter, sometimes only waiting until December, right? Yeah. This is implementing an investment strategy that is looking to take advantage of volatility throughout the year and to trade on the portfolio from a tax management perspective. So yeah, look, we haven't had the volatility that you need to have more tax alpha in these strategies, but nonetheless, there still have been some opportunities, just not as much as what we would typically expect.
Yeah, I think that's the truth. It has to be either a down market, it's got to be a sideways market where you can kind of trade in and trade out, or it's got to have the volatility.
Right.
And we're just not showing any of those three signs in any significant way here in 2024. But guess what?
It's okay.
Just enjoy it. Yeah, just take it. Here's another way of looking at that. We like this. This is kind of interesting slide. It's sort of the dispersion of the S&P 500 constituents, and the larger the bubble is the larger the market cap is for that company.
Right.
And you can kind of see the above 0% line and the below 0% line. Turns out that so far this year, only 21% of the constituents in the 500 are negative territory.
Right. So essentially 100 companies of the 500 are under water or giving you a negative return year to date, and the other 400 are positive.
Exactly. And a typical year, you would actually see 40% of them or 200 of them by year's end actually ending in negative territory. Right. Still interesting when you think about it, the previous slide, still 80% of the years is positive.
Right.
But 40% of the constituents in the 500 are ending negative. But that's a market cap weighted benchmark.
Absolutely. Right.
Regardless, we've got some great performers. You can see NVIDIA up there is just crushing it, right? But the smaller dots represent the smaller cap companies, and they're mostly the ones that are down so far. Maybe opportunities to buy within certain spaces, sure. But from a tax loss harvesting perspective, just not a lot of meat on the bones.
Right. I think there's not a lot of tax loss harvesting, but maybe come back to the previous point of rebalancing, right? And looking at the idea behind rebalancing is to take some profits and redeploy the profits into investments that maybe have better future prospects.
Right. All right, election 2024. Sorry to end it this way. So there's two different things that are out there, and it's betting odds and it's polling data.
Isn't everything betting odds now? I feel like I hear FanDuel ads nonstop.
I mean, there are so many, I'm just not a bettor at all, so I don't even understand what it means. But to be honest, it's very interesting to see the diversion here between the polling data and the betting data. The betting data has it, Trump kind of increasingly over the last couple of months gaining steam. So the odds-on bet is that Trump is going to win.
Right.
But the polling data is showing a slight edge to Harris.
Correct. I mean, make of it what you will. There's still a couple weeks. Anything can happen. I think we've seen, there are plenty of flaws in both approaches.
Yeah.
And none of them are guarantees for anything. So all that to say, no clue what's going to happen. But I think from an investment perspective, I think it's pretty clear. If you were to poll the top investment managers in the world, I think most of them would say not so concerned with who the actual president is, but more concerned with having a divided government.
That's absolutely true. And so to that end, the congressional odds and polls seem to indicate that you're going to get separation. You're probably going to get the Republicans in the Senate
Right.
and the Democrats in the House. Okay, so that's what we're being told so far. So now let's imagine that you don't have a sweep.
Right.
What then does it look like from there for us who are investors looking to kind of try to look into that future and see what it means? All right. Trump presidency, but not a Republican sweep. What's going to happen here? Some of these things are just pretty straightforward.
Yeah, I think most people are pretty well aware of the points that you're seeing here. Again, this slide comes from the S&P Global Market Intelligence. Yeah, a lot of these points are going to be pretty straightforward.
They are. Deregulation, got it. Policy changes at the FTC, the Federal Trade Commission,
Yep.
got it. Have to admit that's probably a good thing in my eyes.
Yep.
Tax cut extensions. That's going to be an interesting one. And of course, we got the Tax Cut and Jobs Act that sunsets at the end of 2025.
Right.
Big debate on what's going to go on there. I'm just going to say that that's still an unknown, even if Trump does get into the office.
Absolutely. I mean, you want to extend it all you want, but if you don't have the votes to do so,
Yeah.
Impossible. You're not the king. You get we gotta get this through the government. So, I look again as a tax nerd. I am I've got eyes wide open on the 2025 Tax Cut and Job Act potentially going away.
Big X factor for us, and that's something we're keeping obviously close tabs on it, and we're planning against it in the years that we have. We still have another, call it 14 months under the current policy, irrespective of what they decide to do.
Correct.
So there's a lot of different levers you can pull and buttons you can push.
Right.
On the tax piece. That's why you need a tax checkup, and if you need a tax checkup, you should be doing it now.
That's right.
Trade war. Look, these tariffs are going to be a thing.
Mm-hmm.
So how they're going to play out is going to be really anybody's guess, but raising tariffs it's going to be potentially inflationary and potentially a headwind to growth.
I think you'd certainly prefer that tariffs be used as like a scare tactic and not something you actually have to implement.
Agreed. I think they can effectively be done in that respect. And by the way, both sides of the aisle are talking about tariffs.
Yeah, absolutely.
Tighter immigration policy, you know that one. Harris presidency, okay, not the Democratic sweep. Increased regs on financial and energy. You got some green economy incentives. Tax cuts below $400,000 annual.
Yep.
I think they're talking about a married couple filing jointly here.
Correct.
It's going to go down. Okay, we'll see. And then increased taxes on the wealthy. Okay, we'll see. Anything to say on those?
I just find it interesting that $400,000 has been decided as the line of demarcation for wealthy and not, but it is what it is.
Yeah.
Again, I think these are pretty well established and understood. These are points that if the election goes this way, this is how it's going to go. I mean,
it is an interesting thing, though. You raise a good point, because I always think about things like this. Okay, if I live in LA or New York as a couple, I'm making $400,000.
Right.
Let's say I'm making $450,000. Am I really rich in that environment?
Yeah.
It's pretty hard to live in those towns for less than that.
I mean, absolutely. That's you compare that to making $400,000 here in Michigan. It's a much different lifestyle and cost of living. But nonetheless, certainly something to keep an eye on.
Immigration. I think there's going to be there's a greater spotlight on immigration irrespective of which party it is. It's really going to come down to what are they going to do and how are they going to do it.
Right.
And then under the Harris administration, I think you'll see more Affordable Care Act, Obamacare, like regulation being sort of fortified.
Sure.
Okay. So what does it really all mean for you?
Let's make a plan.
Yeah, we really think it goes back to that. I mean, you can do a lot of hand wringing over politics.
Yeah.
You've got what you can do out there, which is make your vote. Obviously, every American that is legally able to vote should be voting.
Right.
We want that. but we also want you to make a plan because that's going to be very specific to you, your family, and your future.
Absolutely. Look, we think that this is a cornerstone for for everybody for managing their own finances. If you don't have a plan, you're just hoping. And I'd rather have a plan and have work with a CFP that can help you develop a very good comprehensive plan to better understand your picture and how all these variables might impact you and your family.
Perfect way to end. Thanks everybody for being with us here. This is the last quarterly update for 2024, but we'll see you around the bend in January of 2025.